ETF taxes explained. Maximize returns and minimize costs in 2026. Before we dive in, some ads may appear during the video. Your support allows this channel to keep sharing valuable information for free. Now let's dive in. Imagine for a moment that you have worked for 30 years, meticulously building a 7-figure portfolio, only to discover that a silent partner has been skimming off the top every single year. Most investors think they own their returns, but the IRS often has a different perspective. If you are sitting on a significant balance in a traditional brokerage account, or if you are managing a business treasury, there is a hidden tax leak that could be costing you tens of thousands of dollars in lost compounding. We are entering a period where the margin for error is razor thin. With the recent shifts in tax brackets and the sunsetting of key provisions, the way you structure your liquid wealth is no longer just a matter of preference. It is a matter of survival for your capital. Did you know that 2 investors can own the exact same basket of S&P 500 stocks, yet one might pay 30% more in lifetime taxes simply because of the vehicle they chose? This is the reality of the tax drag, and if you are not optimized, you are essentially volunteering to pay a wealth tax that your neighbors are legally avoiding. The reason this matters so much right now is that the landscape of wealth management has fundamentally shifted. We are seeing a more aggressive stance on capital allocation and liquidity management from the federal level. For business owners and high net worth individuals, the traditional buy and hold strategy in a mutual fund is becoming a liability. Mutual funds are notorious for phantom gains. You could actually lose money in the market during a volatile year, yet still receive a tax bill in the mail because the fund manager sold internal positions to meet redemptions from other investors. You are quite literally paying for someone else's exit. ETFs, however, operate on a different frequency. They use a unique in-kind creation and redemption process that allows them to wash away those capital gains before they ever hit your 1099. As we look at the updated tax thresholds, where the top marginal rate remains a significant hurdle for high earners, understanding this structural advantage isn't just a pro tip, it is the foundation of institutional-grade asset management. To truly master your tax exposure, we need to look at the first pillar of ETF efficiency, the in-kind exchange. In a traditional mutual fund, when an investor wants out, the manager often has to sell stocks to raise cash. This sale triggers a capital gain that is distributed to everyone remaining in the fund. You get hit with a tax bill even if you didn't sell a single share. Recent data shows that while nearly 42% of active mutual funds paid out capital gains distributions last year, only about 8% of active ETFs did. With an ETF, when a large institutional player wants to exit, they don't get cash from the fund. Instead, they receive a basket of the underlying stocks. Because the ETF is trading securities for securities, it isn't considered a taxable sale by the IRS. This allows the ETF to shed its lowest basis shares, the ones with the biggest built-in tax hits, without ever triggering a distribution to you. For a retiree living on a fixed distribution, avoiding a surprise $20,000 capital gains hit can be the difference between a confident year and a stressful one. The second pillar involves the strategic use of asset-based lending and liquidity management. Many of you watching are business owners or have significant equity in your firms. When you need liquidity, your first instinct might be to sell a portion of your ETF holdings. However, if those holdings have appreciated significantly, you are walking straight into a capital gains trap. In the current high-bid lexicon of institutional finance, we talk about buy, borrow, die. By holding tax-efficient ETFs, You can often use those assets as collateral for a line of credit. This provides you with the liquidity you need for business expansion or personal expenses without triggering a single dollar in capital gains tax. You keep your capital invested, it continues to compound, and you avoid the tax bite. This is a level of capital allocation that the general public rarely explores, but it is exactly how the wealthiest families maintain their momentum over generations. Let's talk about the third pillar, tactical tax loss harvesting. This is where ETFs truly shine compared to individual stocks or mutual funds. If you have a position that is temporarily down, you can sell that ETF to lock in a capital loss. Under current IRS rules, you can use those losses to offset an unlimited amount of capital gains, and even up to $3,000 of your ordinary income. The wash sale rule prevents you from buying the exact same security back within 30 days. However, because the ETF market is so vast, you can swap a total market ETF from one provider for a total market ETF from another. They are not substantially identical in the eyes of the law if they track different indices, yet they provide nearly identical market exposure. This allows you to stay invested in the market recovery while building a tax bank of losses that you can carry forward indefinitely. For those of you in the 37% bracket, these maneuvers are essential for protecting your net investment income. Now, as we move into the fourth pillar, we must address the specific needs of retirees and those managing RMDs, or required minimum distributions. If you are over the age of 73 or approaching it, you know the IRS eventually forces you to take money out of your tax-deferred accounts. This income is taxed at ordinary rates, which can push you into a higher bracket and even increase your Medicare premiums. For the current tax year, the standard deduction has been adjusted to $16,100 for single filers and $32,200 for those married filing jointly. By utilizing tax-efficient ETFs in your taxable brokerage accounts, you can bracket manage your income. You can take your forced RMDs from your IRA, but use the tax-free nature of ETF growth in your brokerage account to keep your overall effective tax rate low. Furthermore, for those interested in estate planning, ETFs provide a step-up in basis for your heirs. With the federal estate tax exemption currently sitting at roughly $15 million per person, or $30 million for married couples, the strategy is less about avoiding estate tax and more about erasing capital gains. If you hold these assets in a taxable account until you pass, your children inherit them at the current fair market value. This effectively erases decades of capital gains taxes. If you bought an ETF for $50 and it is worth $250 when you pass, your heir's new starting point is $250. If they sell it the next day, they pay zero tax. It is one of the most powerful wealth transfer tools left in the tax code. To take action on this today, your first step should be a tax drag audit of your current portfolio. Look at your 1,099 DIV forms from the last 2 years. Are you seeing capital gains distributions from your mutual funds? If so, you are losing money to inefficiency. Consider a transition plan to move those assets into comparable ETFs. If you have large unrealized gains, don't just sell everything at once. Work with a professional to execute a multi-year transition that stays within your current tax bracket. Step 2 is to review your dividend strategy. Ensure your ETFs are holding qualified dividends, which are taxed at the lower long-term capital gains rates of 0%, 15%, or 20%, rather than the higher ordinary income rates. For high earners, Remember, the net investment income tax of 3.8% can also apply, making the efficiency of ETFs even more critical. Step 3 is to implement a year-round tax loss harvesting protocol. Don't wait until December to look for losses. In a volatile market, the best opportunities to bank tax savings often happen in the spring or summer. In summary, the transition from traditional mutual funds to a structured ETF portfolio is not just about lower fees. It is about building a fortress around your wealth. By understanding the in-kind redemption process, utilizing asset-based lending for liquidity, mastering tax loss harvesting, and planning for your legacy with a step up in basis, you are moving from a passive investor to a sophisticated wealth manager. The rules of the game are written by the IRS, but the strategy you play is entirely up to you. Remember, it is not what you earn that determines your lifestyle. It is what you keep after the silent partner takes their cut. We provide deep dives into complex wealth strategies like this regularly. So if you found this perspective valuable, please hit the thumbs up button to give us a like as a thank you for this content. It helps the algorithm share these institutional insights with more investors like you. I would love to hear from you in the comments. What is the biggest surprise tax bill you have ever received from an investment? Share your experience so we can all learn from those portfolio pitfalls. And if you want to stay ahead of the next major shift in tax law or retirement planning, make sure to subscribe so you don't miss our next strategy session. I am not your financial advisor, and this video is for educational purposes only. Tax laws are incredibly complex and subject to change. So please seek professional advice from a qualified CPA or fiduciary financial planner before making any significant changes to your portfolio.